I'm going to be discussing about my stock account and today's market. Today, the US stock market is readjusting its prices after the AI boom in the first half of the year. The United Natural Gas closed up 5.98% and SQQ closed up 3.28%, and we can see the market is generally closing lower because of market sentiments. Dow Jones Industrial Average closed down 0.54%, Nasdaq Composite closed down 1.17%, and the S&P 500 closed down 0.7%. Most of the tech industries closed lower, with semiconductors and auto manufacturers closed with a loss of more than 2%. The oil and gas, the energy sector closed at 1.44%. And let's discuss about the U.S. bond market today. This week, U.S. bond auction demand was stronger than expected, and the July CPI may be variable. The first wave of this round of bond issuance, the market's demand for 3-year U.S. Treasuries and 10-year U.S. Treasuries auctioned on Tuesday and Wednesday was unexpectedly strong, and overseas buyers sweep up goods surprisingly. On Wednesday, August 9th, local time, the U.S. Treasury Department completed the auction of 10-year U.S. Treasury bonds, with a total size of $38 billion, with a bid interest of 3.999%, a 7-month high, far exceeding the bid rate for the same period last month, and only slightly lower than the cycle high of 4.106% in November last year. The bid also reflected strong demand, with a bid multiple of 2.56 times, slightly higher than the 2.53 times last month's auction, and also higher than the recent average of 2.45, the highest since February this year. It is worth mentioning that the proportion of overseas indirect purchases, including official institutions such as overseas central banks and private investors, was 72.2%, a new half-year high, far exceeding the previous auction, accounting for 67.7%, and the value of the last 6 auctions of 67.0%. However, direct purchases, including the Fed and other U.S. federal government entities, received 18.3%, down from the recent average of 19.1%. The allocation of ratio of primary dealers was only 9.5%, the lowest proportion since February, as primary dealers must accept new bond offerings when there is a shortage of buyers to avoid auctions. The extremely low allocation ratio of these buyers indicates strong demand. A day earlier, the $42 billion 3-year Treasury note was auctioned, and the demand for 3-year Treasuries was even stronger. Although the auction was a full $2 billion larger than the previous one, it was eventually auctioned at a yield of 4.938%, nearly 2 basis points lower than the yield on the same maturity U.S. Treasury that was being traded before the auction. The auction bid multiple was 2.9 times, the highest since May. The allocation ratio of primary dealers was also only 10.3%, a record low. The sell-off reversed overnight after the week. Ian Lingen, head of U.S. industry at the BMO Capital Markets, said the most critical reason behind the rebound in the U.S. bond this week was the full stimulation of risk aversion. Moody's downgraded the ratings of 10 small and medium-sized U.S. banks this week, and said it was reviewing the ratings of 6 major banks, including Bank of New York Mellon and United Bank of America. On Tuesday, news from Europe hit banking confidence. Previously, the Italian government approved the tax on banks' extra profits this year, which surprised the market. Investors fear other countries will follow Italy's lead, with Spain and Hungary already imposing windfall profit taxes on sector. This development has sparked concern about tighter lending conditions and the ability of the banking system to withstand a sharp rise in interest rates, rekindling a safe haven for demand for U.S. Treasuries. Moreover, the latest dominant statement of some Fed officials also boosted U.S. bond. Philadelphia Fed president and rotating member of FOMC Hack said on Tuesday that the Fed has made progress in fighting inflation and boosting the economy, and that without any surprising new data between now and mid-September, it may be the time to be patient, keep interest rate unchanged, and let the previous monetary policy actions work. In addition, Goldman Sachs, Daimler, Xiaomo, and other. Goldman Sachs, Morgan Stanley, J.P. Morgan Chase, and other U.S. investment banks bucked the trend last week to sink long, medium, and short-term and long-term U.S. bonds, suggesting that the bottom of the U.S. bond also brought some shoulder to cover. In the eyes of these institutions, the recent sell-off in the U.S. Treasuries is somewhat excessive. Goldman Sachs believes the market recent sell-off is untenable. Japanese investors, the big gold holders of U.S. bonds, did not actually start big sell-off last week. The rise in the U.S. Treasury yields last week mainly occurred during the U.S. trading session, not the most active Asia-Pacific trading session of Japanese capital. But analysts remain concerned that the upcoming U.S. inflation data for July on Thursday could be variable, and the 30-year Treasury note auction immediately after the data remained risky. The 30-year Treasury note auction on Thursday was $23 billion, $2 billion higher than the last comparable offering. The market is now forecasting that the U.S. CPI and the core CPI will rise by 0.2% month-on-month, which will bring the CPI year-to-year to 3.3%, but the core CPI will fall further to 4.7%. Once the year-on-year CPI rise ends an 11-year losing streak as expected, investors may need to be careful about the rekindling of interest rate hikes expected and the U.S. Treasury yields rise again. The current supply is being absorbed and the market seems to be ready to respond, but we have to be aware that this could change. Michael DePath, global head of interest rate trading at Citadel Securities, said, "Right now, bond demand is mainly supported by falling inflation. At the same time, the labor market is still facing structural tightening. House prices seem to have bottomed out, and fiscal policy remains quite expansionary. All of this supports the Fed keeping interest rate higher for longer. While bond yields are currently based on the expectation that the Fed will cut interest rates sharply starting next year." That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.